In this video, guys, we're going to look at if you're a day trader, should you leave your day trades alone or should you actively manage them? Stay tuned. Hey guys, a warm welcome to you. All right, so as a day trader, should you be actively managing your trades or should you leave them alone? Now, I'm going to try to look at this objectively. I've got an opinion that works for me. I know it works for me, but let's just look at this completely objectively so you can make your own informed decision from it. Maybe you can go through the decision-making process and go, okay, what should I be doing? Right, so let's just go through what we mean by this. So, leave basically means that I'm going long at this level, my limit is at this level, my stop is at this level. Well, that's it. So you've got your chart. Let's just do a little chart here. We like to do our little charts here. Let's say you're long from this level, your stop loss, in fact no, let's just say you're long from this level, your target is up here. Okay, there's your limit order and there's your stop order here and there's your entry, right? So you're long, there's your limit, there's your stop. That's it. So leaving the trade means doing that, putting your limit in, putting your stop in and not touching it. Managing the trade means, okay, maybe you still have your limit and stop in, but you might do different things to it. So you might trim the position, you might add to the position, you might close the position early. You kind of do different things to the position, so actively managing it. So those are two different things. Let's look at the pros and cons. So the obvious pro for leaving it isn't it easier thing to do, right? All you got to do is make your decision once. Here's the entry, here's the limit, here's the stop, pull the trigger, that's it, nothing more to do. Very easy to execute. So there's a time element to that. Once you've done it, you can do something else, you can look at another trade, you can forget about it completely. It's very nice to do it like that. The other positive, it's good, really, really good for stats and new setups. So in other words, your statistics, you know that if you've always stuck to the trade target, you stuck to the trade stop, if you're trading a new strategy, you know that your number of trades is going to be correct. The outcome is going to be equal to that strategy. You haven't meddled with it, you haven't changed it, you haven't tried to come out early, and which might affect how you adjust and adapt the setup. So let's say, for example, the setup is I've got a 50 ticks target, I've got a 20 tick stop, and I'm trading GBP USD. So you might be trading that. Maybe not so much for a day trade, but you get the idea. You've got this target and you've got this stop and you're executing that under certain conditions. All the data you get, you know that you have executed under those conditions with those parameters, so you can adapt and adjust to suit, right? Because you know that, hey, I'm just out, I'm just this, I can adapt and adjust it, it will be fine. If you're actively managing it, harder to track those results. This is great for new setups and strategies. We can try them out if they're very, very much kind of methodical entries, exits, and stops and limits. So managing, what's the pros of managing? So one of the best ones, guys, you can adapt to conditions, right? You can say to yourself, okay, I'm in this long now. All of a sudden, my proxy market has ripped off the upside. All of a sudden, the volume has increased and we've really picked up momentum. So I'm going to decide to hold this for longer. So you might end up cancelling the limit and holding it for longer. Or you might say, okay, I'm going to close half there instead of all of it and hold the rest of it for longer because I've got data to suggest that we might go higher. I'm reading price action. I'm taking that information from the order flow, especially as a day trader, and I'm assessing it. I'm saying, you know what? This is a real kind of momentum ignition trade. I've spotted momentum ignition here. I am going to say, you know what? I can adjust this. I can remove the limit. I can push the limit a little bit higher. I can squeeze a little bit more juice from this deal. I've taken the risk. I want to be rewarded from it. Anyway, putting that to one side, adapting to conditions is one of the big benefits from it. Of course, the biggest problem potentially you've got, which catches most people out unfortunately, is emotion can control your trades, which is we know we don't want. We talked about this emotional thermometer before, guys. We want to kind of keep it measured. We don't want it too extreme one way, don't want it too extreme the other. We want to keep it measured. Unfortunately, you can become emotional. You might say, oh, I snatched my profits a little bit too early. I can move my stop. If you're inclined to do that, then really you need to not be involved in managing and try to just kind of stick with stuff to build that confidence, and then maybe you can go to managing. So what are my actual thoughts on it? I think that there is something to be said for having this because of the stats and stuff. And I'm a big advocate of saying, okay, stick to your trading plan. However, some people like to do this. So this is my kind of solution for it, is you do a hybrid, but you plan when you will manage it. So you don't go completely on the fly, you plan it. So for example, let's say you're trading a momentum ignition strategy, nice little, you've spotted some price action, you've done all these bits and pieces that we talk about that have lined up nicely for you, you've graded the trade, it's looking great. Okay, now what do? We might say, okay, there are certain parameters that will allow me to adjust the trade to varying conditions. So once we see that this suddenly turns into a grade A momentum ignition trade, we might say, right, I'm allowing myself in my trading plan to take off half at my initial limit and to run half as much as I see fit. But that's written into your plan so that you know, and then you can mark that trade down as a kind of outlier trade that I managed and fell into the plan of this, the parameters were met, the volume had picked up, all these things that we talk about that have given it a grade A status, and I've managed it accordingly. You might even say, okay, if it does this and this and this, then I might be able to add more position size to it again, but it's written down in the plan. So you're only doing things that are planned out, but are giving you some flexibility based on new data that has occurred. Another thing that catches some people out and often frustrates people with this very strict criteria is when the market is pushing up close to the limit and you think, I've run out of steam this, I want to take it off the table, but you want to stick this and it comes back and it stops you out all the time. Now, there's something to be said for leaving it and for getting the data and then adjusting it again, 1 week later and saying, well, actually, look, this is not common. It happened to me once, but I just remembered it because it came up and nearly stopped me out, and then nearly took me out of my trade and then came back and stopped me out. Or you might say, listen, a lot of the trades have done this, so we need to adjust the limit to suit we're a bit out of tune. But you might add something in to say, hey, if it really ramps up to my limit very, very quickly, then I have the override to be able to take the trade out early because it's happened quickly. And I believe that that was just a quick momentum and I might have to sit through a big pullback. Again, you need variables and criteria in there to allow you to do that. Otherwise, you're just trading on the fly. So I think the hybrid is good, allowing you to manage and adapt on the fly based on conditions, but making sure that's written in your trading plan. However, one caveat, guys, a lot of caveats here, but this one is if your emotions are really taking control of your trade, and I know one trader specifically who talks about it, he's like, just leave the thing. He has to walk away from it, and that works for him. He makes money doing that. He trades at currencies and he does well by leaving it and accepting that, hey, I can't manage it because it just frustrates me because I get involved in it too much. I take profits too early, I don't run the trades when I should do, I overrule myself. And if that's a real predominant thing that's hitting you all the time, then definitely stick to this, the leave thing. And just keep adapting and adjusting your plan. Just keep adapting and recognize it. Say, listen, I'll trade it for a week, I'll see how I get on. Right, that's fine. It's not worked out. What do I need to adjust? At least you know the data is solid and you can work and adapt and adjust it and say, okay, I need to bring my limit down a bit. My stop needs to be better. I need to just adjust and adapt this right now. Trade that for a week, trade that for a week, until you find something that works very, very well. So that's the first port of call. The second port of call is the hybrid model based on a plan. And then the final is if you've got that all nailed down, you feel like you're happy running stuff and you're comfortable with running things to the limit when the time is right, you're comfortable extending, and you've shown that you have the ability to actively manage, that improves your results, then you can go on to the full manage. All right, guys, should you leave your day trades alone or actively manage them? Let me know what you guys do in the comment section below. Appreciate your support. Take care. Bye-bye.